Imagine this. Every day, trillions of dollars move silently across screens, while most people worldwide have no idea how this system works. But the truth behind this will shock you deeply. Most beginners think the stock market is gambling, only for rich insiders, or already too late to enter. Today, you will discover why those beliefs are dangerously wrong and what really matters. You will learn how simple shares quietly build wealth, why emotions secretly destroy returns, and how normal people reportedly beat professionals by doing less. Let me show you exactly how this happened. The stock market is not a building or a single place. It is a global system where people buy tiny ownership pieces of companies. These pieces are called shares, and they power modern wealth. In the US, UK, and Europe, retirement money, pensions, and savings depend on this system daily. When markets rise or fall, millions of lives feel the impact instantly. But here is the surprise. According to several studies, most active traders lose money long-term. Yet long-term investors often win by simply staying calm and patient. Stocks represent ownership. If you own one share, you own a small part of a real business. When that business grows, your piece can grow too. People often confuse price with value. Price is what others pay today. Value is what a business earns over time. This gap creates opportunity and also massive mistakes. In the early days, stock markets helped companies raise money to grow factories, hire workers, and invent products. Today, that same idea still drives global finance. But now technology moves money faster than human emotion can handle. Trades happen in milliseconds, while fear and greed still move at human speed. Here is a mini shock. Markets do not move on facts alone. They move on expectations. What people think will happen often matters more than what is happening now. That is why prices jump on rumors, fall on headlines, and sometimes crash without clear reasons. According to experts, psychology controls markets more than math. Bull markets mean prices generally rise over time. Bear markets mean prices fall and fear spreads. These cycles repeat again and again across decades and continents. Many beginners panic during bear markets. They sell low, lock losses, and regret it later. This emotional pattern repeats globally, according to long-term market data. Now here's where things get really interesting. Despite crashes, wars, and crises, major markets have reportedly grown over long periods, rewarding patience more than speed. Think about daily life. Companies you use for phones, food, transport, and entertainment are often public companies. Owning stocks means owning a slice of everyday life. The stock market feels complex because language makes it sound scary. Words like equity, dividends, and indexes hide very simple ideas underneath them. Equity just means ownership. A dividend is money paid to owners from profits. An index tracks many stocks together, like a scoreboard for the whole market. Here is another surprise. You do not need perfect timing. People wait for crashes, miss growth, then buy late. This cycle repeats. Simple consistency often outperforms clever predictions, even by trained professionals. So the first big revelation is this. The stock market is less about intelligence and more about behavior. Calm people usually win over emotional ones. Imagine two friends. One invests slowly every month. The other jumps in and out, chasing headlines. After years, the calm investor often ends ahead. But if you think that's crazy, wait until you hear this. The biggest risk is not market crashes. It is not starting at all. According to several global reports, many adults invest nothing, leaving money idle while inflation quietly reduces its value year after year. Inflation is when prices rise over time. When cash sits still, it buys less later. Stocks, despite ups and downs, have historically fought this erosion. This leads to a hidden truth. Doing nothing feels safe, but it carries invisible risk. Markets punish inaction slowly, not suddenly. Another surprise comes from diversification. This means spreading money across many companies, sectors, and regions. It reduces damage when one part fails. Indexes do this automatically. Instead of betting on one company, you own hundreds. When some fall, others rise, balancing results over time. Now think globally. The US market leads innovation. Europe brings stability. Emerging markets add growth. Together, they form a powerful long-term system. But headlines focus on crashes because fear gets attention. Growth is quiet. Compounding works silently month after month, year after year. Compounding means growth building on previous growth. Small gains stack, then accelerate. This effect looks slow early, then surprising later. This brings us closer to the deeper mechanism behind markets. It is not luck. It is math, time, and human behavior combined. According to historical data, missing just a few strong days can reduce long-term returns sharply. Panic selling often causes that damage. Markets often rise when fear is highest. This feels backward, but it is true. Prices drop first, then recover when emotions settle. Now here's a plot twist. Professional investors face pressure. They must perform every year. Individuals do not have that pressure. This freedom allows everyday investors to win by waiting. Doing nothing can be a powerful strategy if patience is strong. But the system still has risks. Companies fail. Bubbles form. Crashes happen. That is why understanding basics matters before acting. The market rewards those who respect risk, stay diversified, and think long-term. Quick riches are rare. Steady growth is common. This brings us to the most shocking discovery of all, and it changes how everything fits together. The biggest revelation is this. The stock market is not designed to make you rich fast. It is designed to transfer wealth from the impatient to the patient. Every panic sell feeds someone else's calm buy. Every emotional exit becomes another investor's quiet entry. This cycle reportedly repeats across generations. When you zoom out, crashes look smaller. Decades of growth flatten short-term fear. Time reframes pain into opportunity. So what does all this mean for us today? It means beginners are not late. They are early in understanding what truly matters. Technology now gives global access. With small amounts, people can own pieces of the world's biggest companies instantly. But access without education is dangerous. That is why simple rules matter more than complex tricks. First rule, know your goal. Short-term money should stay safe. Long-term money can handle swings. Mixing them creates stress and mistakes. Second rule, avoid emotional decisions. Markets move daily. Your plan should not. Checking prices too often increases fear. Third rule, respect risk. Never rely on one company or one idea. Diversification spreads uncertainty and protects sleep. Here is a small reveal. According to behavioral studies, investors who check accounts less often report better results and lower stress. Now consider the future. Automation, artificial intelligence, and green energy will shape companies differently. Markets will adapt, just like before. Some industries will fade. Others will rise. Index investing adjusts automatically, without needing predictions. This is why long-term systems outperform short-term guesses. They evolve quietly while attention stays noisy. But wait, there is another layer. Fees matter. High fees quietly eat returns over time. A small percentage lost yearly can remove huge wealth after decades. Low-cost investing reportedly keeps more money working for you. This leads to an uncomfortable truth. Complexity often benefits sellers, not investors. Simple systems usually win. Now think emotionally. Fear feels urgent. Patience feels boring. Yet, boring strategies often build real wealth. This does not mean markets are easy. It means discipline matters more than brilliance. According to long-term studies, consistency beats intensity. Small steps repeated outperform big moves attempted rarely. Here comes the final twist. The stock market reflects human progress. As people innovate, companies grow and value expands. When you invest, you bet on global problem solving. That perspective changes fear into patience. If this opened your eyes, remember the opening truth. Trillions move daily, but understanding stays rare. Those who learn early gain time. Those who wait lose it. Time is the one resource markets reward most. Before we wrap up, there's one final thing you need to know. The market does not care about opinions. It rewards systems. Build one, follow it, and ignore noise. This story never really ends. Markets will rise, markets will fall. But the long-term trend reflects human growth. If you stay curious, stay patient, and stay consistent, you align with that trend instead of fighting it. That is the real secret beginners miss. So here is your recap. Stocks mean ownership. Time beats timing. Behavior beats intelligence. Fear sells low. Patience buys growth. Diversification spreads safety. If you found value here, like this video so others can learn too. Subscribe for clear, simple finance stories without hype. Share this with someone starting their investing journey. And tell me in the comments, what part of the stock market confuses you most? Like, subscribe, and share.